discussed about how is the basis for an asset is calculated. Like if you have purchased the asset, or if you uh, have the asset from your inheritance, or if you have your asset as a gift from somebody. So how will you calculate the basis and holding period? We discussed it yesterday. Also, we discussed about the wash sale. So wash sale is the loss that we actually realized but not recognize. Similarly, we have some other losses that we can't recognize. For example, if you have some personal property, any personal losses, then you can't deduct in your form 1040. It will not be recognized. Similarly, if you have some related party transaction related to these assets, and you have some loss, for example, you are selling your shares to a related party, and you have some loss on this transaction, then this loss will not be allowed. So related party loss, wash sale loss, and personal property loss, these are not allowed in the 1040. So today we will discuss about the intangible assets, or how is the treatment for intangible asset is done. So what are intangible assets? Intangible assets are those assets which do not have their physical existence. They provide the long-term economic benefit. Examples of intangible property are goodwill, trademark, trade names, patents, and copyrights. Customer list, licenses, permits, franchise rights, covenant not to compete, computer software, membership or subscription rights. So basically, what should be the basis of intangible asset? So basically, it will depend how you have acquired these property. So whether you have purchased it, or whether you have self created this property, or you have this intangible from your inheritance, or like some gifted by somebody. So depending upon how the asset is acquired, basis will be calculated on that. So first of all is purchased intangible property. If you have some intangible which you have purchased, then your basis will be equal to the purchase price and any directly related acquisition cost. Okay. For example, your legal fees, your registration fees, contract fees, and brokerage fees. So this is for intangible which you have purchased. Next is section 197 intangibles. So section 197 intangible are those intangible which generally acquired as a part of business acquisition, which you have acquired during some business acquisition. For example, your goodwill, your going concern value, customer list, license and permits, your franchise right, covenant not to compete. So these are some section 197 intangibles. So basis is calculated using the section 1060 residual method. So some of the methods like cash and cash equivalent, securities, receivables, inventory, tangible asset, identifiable, intangible, and goodwill. So basically, basis is the portion of the lump sum purchases prices allocated. We will allocate the price if we have acquired some intangible as a part of business acquisitions. Next is if you have some self-created intangible. For example, you have some goodwill which you have internally created. In that case, this will generally have a no tax basis unless specified costs are capitalized. So if you have some intangible which you have self-created, then some of the costs might be capitalized, but they do not have any basis, and generally expenses, they are shown as the expenses in your income statement. Okay. So some of the expenses you can capitalized, like your cost of development, legal cost, any government fees, any research and experimentation. This you can capitalize. Otherwise, other costs are expenses. Next, if you have some intangible which you have inherited or gifted by somebody, then for the gifted intangible, the basis should be carryover basis, and for inheritance, the basis should be fair market value on the date of death. Okay. Any doubt till here?
No, girl.
Okay. So next is amortization of intangible property. So if you are like you are preparing your tax basis financial statement, then what should be the proper amortization method for this kind of intangible property? So for section 197 amortization, like if we have section 197 intangible property, then we need to amortize it over 15 years under straight line methods, which is 180 months, and it will begin on in the month of the acquisition. Okay. If you have non section 197 intangibles, so these are intangibles use useful life amortization instead of the 15-year rule. So if you have non uh, section 197 intangibles, that means which you do not have acquired under business acquisition, those intangibles are amortized over the useful life. For example, your patents, if you have purchased, then it will be a remaining legal life that you use to calculate the amortization. If you have some self-created patent, then it will be 17 years. Similarly, if you have some copyrights, then if you purchase it, then it is the remaining legal life. If you have self-created it, then it is amortized over the useful life. If you have some computer software, so if it is purchased, then it is amortized over 36 months or 5 years under maker's depreciation. If you have off the shelf, then it is 3-year rule, and if you have self developed it, it is usually expensed. Similarly, for goodwill, we can choose section 197 asset. It is amortized over 15 years. And if we are selling it, then it is sold as a section 1231 gain. If you have self-created goodwill, then it will be not amortized, not have any tax basis unless specifically capitalized. Okay, so some of the intangibles are here which you can amortize over your useful life, legal life, or 180 month, depending upon how you have acquired it or whether you have self-created it. Okay. So this is same intangible we already discussed. So next is your character of gain and losses. So as I already told you, if you are selling your capital asset, then the gain or loss resulting from the sale, it will be classified as your capital gain or losses. But if you have some ordinary income property or the property which you are using in a business basically, then it will be classified as your ordinary income property, and any gain and loss will be classified under ordinary income and losses. Okay. So talking about your personal property, so if you have your personal property which you are holding as an investment or using for personal use, then if you are selling that property, it will be a capital gain and losses. But if the property is used in business, okay, for example, inventory, account receivable, your business asset, which are held for less than 1 year. Please note, if it is held for less than 1 year, then it will be a ordinary gain and loss for the business and taxed at the ordinary rate. Okay. If it is held for investment and you are using it for personal purposes, then it will be your capital gain and loss, and depending upon holding period it will be classified as short term gain and losses or long term gain and losses. So our short term capital gain are taxed at our ordinary rates, under which the individual taxpayer is coming under which tax bracket, so it will be taxed at the ordinary rate, whereas long term capital gains are taxed at the preferential tax rate, means usually less than your ordinary rate. Okay. And in case of business, yes,
No, no, nothing.
okay. And in case of business, if you have your property, you're using any property for less than 1 year, then it is ordinary, no problem. But if your asset in a business you are holding for more than 1 year, that means these are providing you the benefit for more than 1 year, then it can be classified under section 120 1231 assets. Okay. So everything about 1231 asset, your section 1245 depreciation, 1250, this is all a part of your TCP section. Okay. I can explain you, but no worries, it will not ask in the reg exam. So under business, just a minute. So if we talk about our business asset, if you have some business asset which you are holding for more than 1 year, then it will be classified as your section 1231 assets. Now you have your asset classified into two categories. First is personal, second is real. Personal means which is movable asset like your machinery, your equipments, your any transportation. Then it is your personal asset that is movable. So these personal assets are classified further into section 1245. Okay, this section 1231 assets are classified into two categories, personal and real. Personal comes under section 1245, and your real property, which is your land, building, anything that is fixed to the land, your real property comes under section 1250 assets. Okay. So when you are selling this section 1231 asset, if you have a loss, then loss is classified under 1231 loss. Okay. Section 1231 loss, which is usually taxed at the ordinary rate. Ordinary rate. But if you have some gain on this section 1231 asset, then gain is treated differently depending upon whether it is your personal asset or whether it is the real asset. So if it is personal asset, then up to the amount of your depreciation recapture, this gain is classified as your ordinary gain. And remaining gain, like excess of depreciation, this will be classified as your section 1231 gain. Whereas if we talk about real property, then it is treated differently. Your if you are C corporation or if you are a flow through entities, then it will be treated differently. So up to the amount of your depreciation recapture, it is classified, sorry, up to the amount of your excess of straight line depreciation and your appreciated depreciation, it is classified as section 1250 ordinary gain, and up to the amount of your straight line depreciation, it is classified section as your section 1250 gain, and remaining gain is classified under 1231 gain. So these treatment for different properties, it will be asked in your TCP section, not here. So I am giving you the idea related to this. Your section 1231 asset is classified under 1245 and 1250. For 1245, up to the amount of depreciation recapture, you classified it as ordinary income, as an ordinary income, and taxed at your ordinary tax rate. Whereas if you have real property, then up to the amount of straight line depreciation, it will be taxed at some preferential tax rate, which is 25%. It actually have some classification which I told you. The excess of straight line and makers depreciation is first classified into ordinary, then up to the amount of straight line is classified under unrecaptured, and then it is classified under 1231. So don't worry, this is not relevant for your reg exam. Okay, so except this, any doubt?
No.
Because it is a detailed topic in your TCP, not in reg. Okay, so how is capital gain and losses are treated for an individual taxpayer? So capital asset, if you are selling your capital asset, then it is a capital gain or loss. So how is it treated? So if you have your short term and long term, short term are taxed at the ordinary rate, whereas long term gain are taxed at the preferential rate. Okay, so if you have your losses in as capital losses, then these capital losses you can use to reduce your capital gain. Okay, and any excess of losses you can reduce up to the amount of $3,000 from other sources of income. Other sources of income. Okay, so if you have any excess of loss, then you can deduct from up to 3,000 of losses from your other sources of income, and remaining loss you can carry forward to the next year. Okay, so first of all, you will try to set your capital losses against your capital gain. And if you are left with excess of loss, then up to $3,000 you can deduct from your other sources of income, and rest of the loss you can carry forward to the next year. Okay. And if you have your multiple short-term gain and multiple long-term gain, multiple uh, gain and losses. So how do you net these gain and losses? So first of all, if you have short term gain, then try to net it off with your short term losses. Okay, similarly, net long term gain, try to net it off with your long term losses. Okay, so after netting these short term with the short term and long term with the long term, you are left with some short term capital gain or some short term capital losses. Similarly, long term gain or long term losses. So if the sign of this short and long are opposite, then you can set off against each other, like set off short with long. But if they have opposite sign, then you need to take them separately. Okay, like show in your form 1040s separately, because your short term is taxed at ordinary rate, whereas long term is taxed at the preferential tax rate. Okay, if they have opposite sign, then you can set off with each other. If you have some excess of losses, then you can deduct up to 3,000 as I told you, and excess losses you can carry forward to the next year. Okay. So, yes,
Okay.
special long-term capital gain rate. This is for the business property which we classified under section 1231 asset. Okay. So it will be in your TCP, no problem. Unrecaptured section 1250 is at 25%, collectibles is at 28%, qualified small business stock it is at 50 or 75% exclusion. Okay, talking about some example. Suppose you have your gain 2000 and your loss 5000. So as per the rule set, you can net off these gain and losses with each other. So you are left with net short-term capital loss of 3000. And you can deduct this up to 3000 of loss against ordinary income, and rest you can carry forward to the next year. Since there is nothing to carry forward here, so no need carry over needed. Okay. Now suppose you have long-term gain of 12,000 whereas short-term loss of 4,000. Since they have opposite sign, one is gain and one is loss, then you can set off against each other and you are left with 8,000 of long-term capital gains. Okay. So gains which are long-term, they are taxed at the preferential tax rate. Any doubt till here?
No, Garima.
Okay. So these are for individual. If we talk about the C corporation, then you cannot deduct any capital losses from the other sources of income. You can only deduct your capital losses against the capital income. But yes, you can carry forward as well as carry back these losses. Okay. So for C corporation, you have classification capital gain and loss, but these are do not taxed at the preferential tax rate. These are taxed at the ordinary rate, that is for the business, which is 21%. Okay. L- Losses rule said you can deduct only against your capital gains, and if you have excess of capital losses, then you can carry back or carry forward, but do not deduct under from the other sources of income, as in case of individual. Okay. So how much carry back and carry forward you can do? You can carry back for 3 years and carry forward for 5 years. Okay. Always carry to the earliest year first, and it is treated as short-term loss in carry years regardless of the original character. So if you have some carry forward or carry back losses, then it will always treated as your short-term. Clear?
Clear.
Section 1231 asset. Okay, so if you have some section 1231 gain, it is classified under long-term capital gain, and if you have section 1231 losses, it will always classified under ordinary losses. Okay. So suppose you have some capital gain of $100,000 for a corporation. Then, as I told you, there is no special tax rate for corporation for capital gain and losses. They are always taxed at 21%, which is ordinary rate. Okay. If you have some capital losses, you can't deduct other source from other sources. You can only deduct this amount up to the amount of your capital gain. So since no capital gain are here, you can not deduct against other sources. Instead, you can carry back and carry forward if you have some capital gains in your carry back year or carry forward years. Okay.
Okay.
Okay. So here it is. Are you saying something?
No, no, I just said okay.
Okay. So this is also a part of your TCP section. So if you are selling your personal residence, means if you are selling your personal property, and since it is a personal property and it will result in some capital gain and losses. So if you have losses, no worries. If you have gain, no worries. You can sorry, if you have losses, you do not allow to deduct your losses since it is your personal property loss. But if you have gain, you have to pay taxes on this gain. But certain exemption is there, like if you are selling your personal residence which you have hold it for at least 2 years and lived in that home for 2 years in the past 5 years. So if you see in the last 5 years, if you have 2 years of ownership and 2 years of residency in that home, then you can deduct these gain up to the amount of $250,000 if you are a single, and up to the amount of $500,000 if you are a married filing jointly. Okay, but this exclusion, this exemption is allowed only once in a 2 years. So in 2 years, you can get this exemption only for one time. Okay. So if you have taken this exemption, then you have to wait for 2 years to get the another exemption. Okay. So partial exclusion is happen like if these tests are not met, but you have changed your residence, your home due to the change in place of employment, like it is the demand of employment that you have to change your home, then it will be partially allowed to deduct these to defer this gain. Also if you are you do not have to fulfill these criteria, if in case you are changing your home due to some health reason or unseen circumstances as approved by IRS, so in this case you have some partial exclusions instead of full exclusion. Okay, so this is the formula to calculate the partial exclusion. No worries, it will be in your TCP section. Non-qualified use, like if you have home had rental or non-residence use after uh, 2008, then portion of gain attributable to non-qualified use is not excludable. Like if you are using the property for non-qualified purposes, then the exclusion is sometimes partially allowed. But in case, like if after your residency you are giving the property for rent, then in that case this is not allowed. Losses on sale, so as I told you, if you have personal property and you have some loss on the sale of this property, then these personal losses are not allowed. Okay, wash sale losses, related party losses, I already discussed. Related party losses, hobby losses. So if you have some hobby losses, like if you are running some kind of business, not for profit but uh, for your hobby purpose, so in that case your income is taxable, but your losses are not allowed. You can deduct your losses up to the amount of your income, otherwise net losses are not allowed to deduct from your other sources. Commuting expenses. So if you are commuting between home and workplaces, like if you are traveling from your home to workplace, then this expense is not allowed. Capital loss limitation already discussed. Passive activity losses, means if you have some passive activity losses, then these losses can be deducted only up to the amount of your passive income. Vacation home or loss rule, we already discussed it. Okay, any doubt till here?
No, very much.
Next topic is depreciation. So since you have some property and there will be a depreciation charge on it. So if you are using it for personal purposes, then depreciation, this expense is not allowed to deduct in your form 1040. But if you have some property which you are using for the business purposes, then there will be a need to calculate some depreciation on this property. This method for depreciation is different in case of your book income purposes and your tax income purposes. So depreciation is basically a cost recovery system that allow you to deduct the cost of business use tangible property over time. To have some depreciation expense to be deductible, the property should be used in trade or business or held for production of income and have a determinable useful life greater than 1 year. And please note, land we is not depreciable. We do not calculate any depreciation on the land. Okay. So for the tax purposes, we use the maker's depreciation system, that is modified accelerated cost recovery system. Under this, we have two systems, which is GDS and ADS system. Okay, GDS is a default system, like which will be applicable. Alternative depreciation system is applicable under certain condition, which is slower method and straight line method we used. So under makers depreciation, we have some classification of asset, like which gives you about the useful life of this specific asset. So under GDS, we have these classification, like we have 3 year property, 5 year, 7 year, 27 and half year, 39 year. So 3 year is for special tools, like special tools, tractors. 5 year for computer, office machinery, auto, light trucks. 7 year is for office furniture, fixtures, equipment. 27 and half year is for residential rental property, and 39 year is for non-residential real property. So these year you have to remember because it can ask you in simulation. Okay, so there might be some simulation. Definitely from this topic a simulation is usually come, in which you have been given some kind of asset. You sometimes the this useful life is given, and sometimes you have to fill which should be the useful life of this asset. Like you can given some asset, first is computer, furniture, some business inventory, any land and any other thing. So you need to consider, since land you do not depreciate, then it do not have any depreciation. Inventory, it is it depreciation is not calculated, it will be under your ordinary income property. Or if you have some computer, then it will be a 5 year property. Okay, so you need to remember how much is the useful life is under maker's depreciation for specific types of asset. Okay, so which convention we use? So generally, if it is a personal property, that means this 3 year, 5 year, 7 year, then you have half year convention as well as mid quarter convention. Half year convention means you will take the depreciation for the half year, if uh, irrespective of when you have purchased this property or put into use. Okay, so you can use half year convention. This is default for personal property. Like if mid quarter is not applicable, then that means always half year convention you will use. Okay, it will be treated that you have placed this asset in the middle of the year. But if your 40% greater than 40% of assets, whichever asset or a multiple of assets are given, in the question. You have to check their date when they are placed in services. So if more than 40% of assets are placed in the last quarter, then you will use the mid-quarter convention. Okay. But if you have this real property like residential rental property or non-residential real property, then you should use the mid-month convention to calculate the depreciation. Okay. So curse depreciation is the method you use for depreciation. For certain business property, we have some special types of expenses which is called Section 179 expense and bonus depreciation. Okay. So Section 179 expense allow you to deduct some of the expenses immediately in the first year. Okay, so Section 179 expense is usually uh, it is an option, not a mandatory thing. It is an option that you can deduct your expenses related to some property in the first year. Okay, so which property is applicable under Section 179? The property should be your new or old tangible personal property. Okay, please remember Section 179 is applicable for your tangible pers- uh, personal property. Personal. Okay, or off the shelf computer software also. Okay, but it will not be applicable for your real property or you or any property which you are acquiring for the from your related party. Oh, clear?
Yes, clear.
So section 179 expense. First of all, you have to check whether the property is qualified property or not to deduct these expense. So it will be applicable on tangible personal property or off-the-shelf computer software. Not for real property. Real property के लिए नहीं है ये. But for real properties, one exemption is there that if you have made certain qualified improvement, if you have some qualified improvement related to a property which is HVAC, heating, ventilation, or air conditioning, any fire protection, any alarm system. So if you have certain qualified improvement, then you can deduct these expenses for this improvement under section 179 expenses. Okay. But if it is a real property, then no. But if you have some qualified improvement on this real property, then these improvement can be taken as 179 expenses. Okay. So it will be applicable only in the first year in which you have placed it into use. Okay. Only given only for the first year, and limit is uh, 1.22 million. It was for 2024, but now for 2025 it is, I think, 2.5 million. Please confirm this limit from your book if you have new edition. So this for 2025 it is up to the amount of 2.5 million of expenses you can deduct in first year, but there is limit that you can deduct these expenses up to the 2.5 million. If you have greater than 2.5 million, then up to 4 million you can deduct, and after this it will start phasing out completely. Okay.
Okay.
So you can deduct up to the amount of 2.5 million. If you have expenses greater than your 4 million, then it will start phasing out. Okay. Please remember, it is given only in the first year when you place your asset into service. For bonus depreciation, it is also given for the personal property, not for real property. And also, if you have this property from related party, then this is also not applicable for bonus depreciation. It will be applicable for the personal property, new or used tangible personal property, which should have a maker's life of 20 years or less. Again, here, your personal property, intangible personal properties, and have maker's life of 20 years or greater than, 20 years or less than 20 years. 20 years or less than 20 years, it will be applicable. It is not allowed for real property. And for bonus depreciation, you have your limit for bonus depreciation is 40% in 2025. Okay. It is phasing out by year, like it was 60% for 2024, but now for 2025 it is 40%. For 2026 it will become 20%. Okay. Please remember, bonus depreciation is also applicable only for first year, and is taken after you deduct 179 expenses. So if you choose to have section 179 expense as well as bonus depreciation, so first of all you should deduct your 179 expense, then go for bonus depreciation. Is it clear?
Yes.
Okay. Then after 179 and bonus, you have your maker's depreciation. Okay. Maker's depreciation, you can deduct up to the life which is applicable, but these two expenses you can only claim for the first year. Okay, if you are using the ADA system, then you can use the straight line depreciation for the real property or ADS property. So this is same again. Okay, so for example, you have some asset in the business like a computer which is costing around $10,000. So if you applied your maker's depreciation here, since computer is a 5-year property, and by default, since no dates are given, by default you will take the half-year convention. Okay, and 200% depreciation will be applied on this computer. So if you calculate the depreciation, it will comes around $2,000. But if you have placed like you have some multiple computer or even a single computer which you have placed in the in quarter 4, or if you have multiple asset, then you have to calculate whether you are putting more than 50% of asset in the quarter 4, then you have to use the mid quarter convention. Okay. If instead of personal property you have some real property, Then real property is depreciated under 27 year or 27 and half year or 39-year property. So if you have your real property, it will be classified under 39 and you can use the straight line method. And for real property, you should use the mid-month convention. Okay, so if you calculate these amount, your depreciation amount will come this. So any doubt till here?
No worry.
Okay, so in the next class, I will take some questions related to this depreciation because it is an important topic and asked in exam. So please revise till here.
Okay. Tomorrow we will be having the classes.
Sorry.
Tomorrow we will have the class.
Yes.
Okay. Okay. Got it.
Okay. Okay, then revise up to here.
I will do that.
Okay, then we will continue tomorrow.
Yeah. Bye bye.
Okay, bye.